Hi everybody, good morning. It looks like we've got most people in now, so I think we'll make a start. So as I said, very good morning to you all, and thank you for joining us for this 1 hour Accentuate by K3 Hub regulatory and technical update. We've got two sets of speakers today that you've probably seen on the invite, but before I get to that, for those who haven't virtually met me before, my name's Marie, and I'm a managing director here at Quantuma. And on behalf of our parent company, the K3 Capital Group, I'm responsible for the K3 Hub, which is a member network for professional advisors developed by us and other companies within the K3 Capital Group. Since we launched in the spring of 2021, I'm proud to say that we now have over 2,750 like-minded professionals in our network, and through the network, they've accessed a range of CPD and training sessions which are not dissimilar to today's event, and also referral fees for certain types of work referred into the group. A few pieces of housekeeping for you, if you can just humour me. I'm always asked this, so just to confirm, we are recording today's session. You probably heard the announcement on the way in. We will be putting this onto the K3 Hub website, and that'll be there next week. Q&A function is open, so please do feel free to ask questions as we go along. Just to cover off, I am going to run two sets of Q&As today, one for each speaking team. It's my intention to hold back the questions that you ask until the end of each session so that our speakers can get through their context. I know we've got quite a lot to cover today. So if your question is quite specific, I'd be grateful if you could give me some context so that I can make sure we get those answered nice and efficiently for you. The preference for questions is if you could use the Q&A function, so I'm just pointing in one place rather than the chat. That would be great. We are going to post the slide presentation into the chat, and I think I've just seen that being posted now. I think we just posted it, and we'll probably post it a couple of other times throughout the session for those who join us a little later. In the second session, our speaker Jeremy has got a couple of poll questions. We'll run those at the beginning of the presentation, and obviously I'd be grateful for your participation. Now, under normal circumstances, it's usually my role and my honour to introduce our speakers, but on this occasion, I think I'm going to leave my colleague Victoria to introduce her and her team. So Victoria leads our internal quality and risk team, and if I do say so myself, they're probably one of my favourite teams in Quantuma. So Victoria, without further ado, I shall hand over to you to introduce the team and run through all of the content for us.
That's lovely. Thanks very much, Marie. So good morning, everybody, and welcome to the regulatory update part of this webinar this morning. As a brief introduction, my name is Victoria, and I'm the Quality and Risk Managing Director at Quantuma. So my team covers a range of compliance requirements across both Quantuma and the K3 Group, and today we'll be talking to you about a number of regulatory developments. So joining me on this part of the webinar will be my colleagues Susie and Seema. Again, as a brief introduction, Susie is our Economic and Financial Crime Senior Manager, while Seema is our Data and Privacy Senior Manager. And together we're going to be covering the following topics. So first of all, we're going to be going through the new ICAEW CPD requirements, then moving on to a brief outline of the Economic Crime and Corporate Transparency Bill. We're then going to be looking at changes to reporting material discrepancies to Companies House, and then finishing off with a data protection update. So let's get started with our first agenda item, which is CPD. So I'm sure everyone on this call knows what that is, but just in case not, we're going to be talking about continuing professional development. So with effect from the 1st of November, the ICAEW are introducing new CPD requirements, including a minimum number of hours ranging from 20 to 40 hours per year, depending on your job role, some of which will need to be verifiable. The ICAEW say that the changes are being made, and I quote, against a backdrop of intense scrutiny of the accountancy profession and increased regulatory expectations to provide greater clarity on the amount of CPD that members should be doing to ensure that they have up-to-date professional, technical and business skills. So I should stop here and make an important point, and that is that these new regulations only apply to ICAEW members and member firms. So individuals that are regulated by any other regulatory body, for example, the ACCA or ICAS, must adhere to those regulators' CPD requirements, even if they work for an ICAEW member firm. So if you are an ACCA accountant, for example, you continue to comply with your regulators' CPD requirements. Right, so moving on, now let's have a look at the changes. So currently, the ICAEW does not require members to achieve set CPD targets. However, from the 1st of November, 3 CPD categories will be brought in, which will be dependent on job role and the functions that you carry out. Each category requires a minimum number of CPD hours to include compulsory verifiable hours and 1 hour of ethics training. Minimum hours apply whether you work full or part-time, but can be prorated for periods of absence from work. So for example, if you have taken maternity or paternity leave, or have had a period of time off work due to sickness, for example, you would just prorate the amount of CPD that you needed to do for the year. In terms of responsibilities, ICAEW individual members are responsible for completing the minimum hours required by their CPD category. However, ICAEW member firms are responsible for ensuring that all relevant staff members, i.e. those who are individual ICAEW members, have carried out the required amount of CPD for their roles. They must also maintain records of the CPD undertaken, including the verifiable element, and they must be able to make available to the ICAEW Quality Assurance Department on request the CPD carried out by relevant staff. So, for example, if you have a practice assurance visit, this is just the sort of thing that they could ask to see. So moving on, next, let's look at the verifiable CPD and ethics training requirement. As I said above, each CPD category specifies a minimum number of verifiable hours. Verifiable CPD must be evidenced, i.e. it must be fact-based and be corroborated. So examples of that sort of CPD include external and internal courses and conferences, webinars, seminars, and even technical research for an article or presentation. In terms of the ethics requirements, helpfully, the ICAEW has produced an ethics CPD course which provides 12 hours of verifiable CPD. And on the slides, you'll see that we've provided a link to that. While the requirement is that a minimum amount of 1 hour of ethics training should be completed, you can, of course, use the whole 12 hours provided, which will count towards your CPD target for the year. And the best bit is that the course is completely free. So now let's think about some practical steps. So member firms should firstly identify their relevant staff, i.e. who are ICAEW members. Those relevant staff should be required to use the CPD self-assessment tool provided by the ICAEW to confirm which category they fall into and therefore what their annual target is. Members and member firms should consider how CPD is recorded so that this can be monitored through the year. If you have an online HR system, this is an ideal way to do so. If you don't, then there is a resource on the ICAEW website which provides pro forma and ideas for recording CPD. In terms of annual targets, consider how this will be monitored and prompted through the year. So, for example, you could consider doing this during PDRs and or setting up processes to monitor targets on a quarterly basis. Ideally, CPD hours should be gained steadily throughout the year, as opposed to all crammed into the end of the year, or when you know the ICAEW are coming for a visit. Something else that you need to be able to do, following on from the ICAEW visit, is to ensure that training records can be easily extracted should they be requested. And lastly, to assist relevant staff in meeting CPD targets, firms can consider publicising webinars and other training opportunities. So while the CPD targets now probably are a little higher than we're used to, there is still a lot of free resource online and also on the ICAEW website. So hopefully this shouldn't be too onerous financially. And so lastly, we've just put a couple of helpful resources on this slide. The ICAEW has done a really good job on their website of providing a lot of information about the new requirements and also a lot of resource. So we've got the link to the overall web page, and also the online CPD self-assessment tool. So this is a really, really good tool which just asks a couple of questions and will tell you what your CPD category is. So I'm now going to hand over to Susie. Thank you.
Thanks, Victoria. I've got two topics to cover for you today, the first of which is the Economic Crime and Corporate Transparency Bill. This was first introduced into the House of Commons in September 2022 and has been subject to a significant debate in both the House of Commons and the House of Lords. It builds on the previous Economic Crime Transparency and Enforcement Act that was introduced in 2022 and is quite a wide-ranging bill. It includes significant Companies House reform, which can include compulsory identification checks for new company officers before formation of a company, and gives Companies House the ability to query information which they believe suspicious, misleading or fraudulent. There's also powers in there to seize crypto assets more quickly and easily, and also provides new intelligence gathering powers for law enforcement. There's two significant changes that are proposed by the bill which I wanted to cover today, which are the expansion of the scope of persons whose criminal conduct can be attributed to the company itself, and a new offence that's been created of failure to prevent fraud. The bill itself had been subject to proposals for significant change in the House of Lords. So it's actually been returned to the House of Commons, actually now for the third time, but it is likely that the bill will receive royal assent before the end of the year, and therefore there'll be forthcoming in the new year potential additional requirements that need to be met. So moving on to the next slide. The first topic that I wanted to look at was the expansion of the scope of persons whose criminal conduct can be attributed to the company. So under current legislation, an offence must be committed by the controlling mind and will of a corporation in order for the offence to be attributed to the corporation itself. Under the proposed changes, companies will now be liable for economic crimes committed by senior managers. In the legislation, senior managers are currently defined as individuals who play a significant role in the decision-making, management or organisation of the organisation of its activities. The Act itself does not have to benefit the organisation in order to be caught. So there is an additional expansion of who potentially could fall under the criminal conduct that's been attributed to the company. The second one, moving on to the next slide, is the failure to prevent fraud offence. So these are measures that are coming around in order to help tackle the level of fraud offences committed in the UK. Fraud now accounts for over 40% of crime in England and Wales, so the legislation is considered very, very timely. There's similar legislation already in place in relation to failure to prevent offences in relation to bribery and tax evasion, and this failure to prevent fraud is really following in those footsteps. The types of fraud are detailed on the screen and include criminal offences that are identified in the Fraud Act and the Theft Act, and also in common law, so include fraud by false representation, fraud by failing to disclose information, fraud by abuse of position, participation in fraudulent businesses, false accounting, fraudulent trading. The offence does not include fraud that is carried out for a personal gain, only gain of the company that the individual is employed by. The House of Lords, when looking at the initial draft of the bill, wanted to consider including a failure to prevent money laundering offence as part of the legislation, but this was rejected by the House of Commons, who considered that the existing regulations in that regard are sufficient. So moving on then to what companies will be affected by the legislation. This particular point on this legislation has been subject to quite significant debate, and that debate has actually been getting quite fiery between the House of Commons and the House of Lords. So the initial intention was that only large corporations would be caught by this new legislation, not companies that fall within the SME category. So the proposed legislation was defining a large company as one that met two of the following criteria: having more than 250 employees, having more than 36 million in turnover, or having more than 18 million in assets. The House of Lords proposed an extension of the scope of the companies caught, which has already been rejected twice by the House of Commons. the House of Commons have argued that the cost to medium-sized enterprises would likely to be in the region of £300 million in one-off costs and nearing £40 million in annual recurring costs, should the legislation capture those considered to be of medium size. This was actually subject to further debate in the House of Lords on Wednesday. The House of Lords were encouraged by the Commons to accept the proposal to take a proportionate approach and not to impose unnecessary measures that will curb economic growth. The Lords have been quite vocal in their desire to see that the legislation is expanded across companies of a much wider range. In fact, Lord Garnier said that a straightforward principle that the criminal law should be uniform and it should apply to all in exactly the same way. He noted that the bill will only currently affect 0.5% of the corporate economy, and also noted that there weren't similar exceptions in the bribery or tax evasion offences. He agreed with some comments from some MPs who actually supported the bill having a wider range, who found it puzzling that their own government, a government who are in favour of producing cogent and cohesive criminal law, have come up with this dog's dinner. So it's been getting quite feisty in terms of the objections to there being an imposition of a limit, but obviously this does have a massive implication for SMEs if they are subject to this additional legislative requirements. Ultimately, the outcome on Wednesday was that House of Lords have voted to ask the Commons again to rethink the provisions regarding the failure to prevent fraud for small organisations. So this one is a little bit of a watch this space, but potentially the outcome of this could have quite far-reaching consequences for SMEs. Moving on to the defence that's available within the legislation. So in order to have a defence, companies are required to have reasonable measures in place to prevent fraud. The original Bribery Act, which was the first of the legislations to have a failure to prevent offence, required that adequate measures were in place. And in fact, in the tax evasion legislation that was brought in under the Criminal Finances Act in 2017, that had been reduced somewhat to having reasonable measures in place. The failure to prevent fraud offence follows suit with the tax evasion. So it's really looking at what reasonable measures may be available. So it is likely that corporate entities will need to revisit their fraud risk assessments and consider whether additional measures and training are required. Just finally on this section, I wanted to just briefly look at what's next. As I've mentioned, it is still subject to final approval, so there could be some significant differences in the final legislation with regards to who is going to be caught by the failure to prevent fraud offences. The bill itself does leave it open to expansion of those offences in the future, so the Secretary of State will have the power to pass secondary legislation to remove or add further predicate offences in the future. So that could include one of dishonesty or offences of a similar character to those already in scope. And it does leave the door open for potentially for a future money laundering offence to be added as well. But ultimately, once the legislation has come into being, then the government guidance will be issued on what the sort of reasonable fraud prevention measures that are required are likely to look like, and those will need to be issued before the offence comes into effect. That's the first of the two topics. The second one, which I just wanted to give you a brief overview of, was changes that have come into effect with regard to reporting material discrepancies to Companies House. The requirement for UK companies to submit information with regard to persons of significant control has been in force since 2016, and it was introduced to make ownership and control more transparent and accessible to both the public and to authorities. Its aim was to prevent criminals from using companies as vehicles for money laundering, tax evasion, terrorist financing and corruption. This point was strengthened in the Money Laundering Directive in 2020, which introduced the original new reporting requirements regarding PSC discrepancies, whereby obliged entities were required to consider the PSC register of prospective new clients and report any discrepancies to Companies House. So I wanted to start by having a quick look at the changes which are being implemented in the new regulations. So these are largely that entities are now only required to report material discrepancies in certain circumstances. Specific examples of the material discrepancies are now provided in the legislation. There's now an ongoing requirement to report material discrepancies rather than only during initial client due diligence, and that the discrepancy reporting has been extended to discrepancies on the new register of overseas entities. I'm just going to have a quick look at more detail in the first three of these changes. So firstly, what discrepancies need to be reported. So obliged entities must only now report a material discrepancy if it can be reasonably linked to money laundering, terrorist financing, or concealing details of the business of the customer. In Companies House guidance, it says that obliged entities do not need to consider whether the concealment is deliberate or not, but must consider whether it could objectively be considered to be concealing the PSC. Submission of the PSC discrepancy reports doesn't replace the requirement to submit a suspicious activity report where there are suspicions of money laundering. So additional consideration will need to be given as to whether a SAR is additionally required. They have also stated that if a material discrepancy is resolved before you submit the report, then there is no requirement for you to submit a report. Just moving on to examples of material discrepancies. As I said, the new legislation now provides examples of material discrepancies that could be linked to these conditions. So these are listed here, and I just want to have a brief look at a couple of these in slightly more detail. So, for example, a difference in name. We're looking for examples where they might suggest a different person rather than just a spelling error, so, or perhaps a shortening of a name of, say, Victoria to Vicky. Errors which might be more likely to be considered material would be, for example, the missing part of a hyphenated surname, or if you were looking at a legal entity and there was a missing name word from the company name, perhaps suggesting that it was a different legal entity. During client due diligence, if documents are obtained to verify identity, such as a passport or driving license, and those identify a different date of birth or a different nationality than that stated at Companies House, then those could fall within the material discrepancies. Similarly, if you identify a missing entry on the PSC register, you would need to detail when submitting a discrepancy report why you consider that individual to be a PSC or beneficial owner. Just a couple of other points on that. If you do identify a discrepancy, you may still want to contact the company to correct that discrepancy, even if it's not ultimately considered to be material. But ultimately, if you do decide that a discrepancy identified is not material and does not need to be reported, then it is recommended to keep a record of the rationale of that decision that you've made. Finally, I just wanted to look at ongoing reporting. So previously, obliged entities were only required to report discrepancies at the outset of the business relationship. The new regulations now require discrepancies to be reported throughout the relationship. So a business must obtain an excerpt from the PSE register when updating CDD or performing ongoing due diligence. Companies House has said that they will not be able to advise on the specific requirements for individual obliged entities, so advice should be sought from supervisory bodies and industry guidance on the frequency and timing of ongoing monitoring. There is also no requirement to report a material discrepancy twice. If it's already been reported but not corrected, you're not under an obligation to report it again. Ultimately, there is guidance on this available from Companies House, but I just wanted to provide you with a brief overview of these changes that came in. That concludes my part of the presentation, so I'm now moving on to hand you over to Seema.
Thank you. So my presentation is about the GDPR and an update on the GDPR. And it's been 5 years since the GDPR came into effect. And as a privacy professional in Quantuma, I can say that the general awareness of the regulation has grown exponentially since it came into effect. And really, I don't think there's anybody who doesn't know, doesn't have an awareness of the regulation. So in many ways, I realized this slide may be superfluous in this context because of the awareness of the regulation. And so I considered whether to remove it or not. But then again, I thought this would act as a little warm up for me while my nerves settle and I get into the flow of the presentation. So here we go. In a rapidly changing world, digitizing world, the aim of the GDPR was to give individuals control over how organizations use their data. On the flip side, organizations are required to adhere to the obligations in the GDPR, and non-compliance can result in enforcement notices. I cannot think, I mean, most entities in most businesses in the UK handle personal data in some capacity. So really, I cannot think of any organization that will be exempt from the obligations of the GDPR. Slide, please. The focus of this presentation is not so much about recapping the GDPR, but more to explore the status of the regulation going forward. Sponsored by the Department of Science, Innovation and Technology, the Data Protection and Digital Bill was introduced to Parliament in July 2022 to much fanfare. The aim of the bill was to simplify data protection regulations, remove some of the more onerous obligations from businesses without compromising the adequacy status of the EU. The million-dollar question is whether this delicate balance can be achieved, and that we can achieve innovation and competitiveness on a global scale without raising barriers to trade, which is what will happen if the UK loses its adequacy status. Slide, please. The principle of accountability, as it currently stands, requires organizations to implement a data protection framework and evidence this. The regulation outlines the specific measures that organizations must undertake to demonstrate compliance, and the ICAEW website provides plenty of guidelines on this. Compliance can be demonstrated through the strength of policies such as a data breach reporting protocol, clear and transparent privacy notices, and technical protections to data. The bill introduces 3 interesting changes to the accountability principle. The first one relates to the position of the DPO. Currently, 3 types of organizations are required to appoint the DPO. A, public authorities. B, organizations that monitor individuals systematically, regularly, and on a large scale. For example, that might be a firm that tracks online behavior for e-commerce purposes. And C, organizations that process special categories of data on a large scale. For example, a firm that may offer genetic testing. The bill abolishes the role of the DPO in favor of a senior responsible individual. But the basic tenets of the role remain, in the sense that only public authorities and organizations with high-risk data processing are required to appoint an SRI. In reality, for most organizations, the introduction of an SRI does not make much of a difference and is little more than a change in job title. This is because in most firms, data protection compliance is not a standalone function and instead is an integral part of the company's wider data protection strategy. Of the documentation that organizations are required to produce to demonstrate compliance, 2 are arguably the most onerous. First is the records of processing activities, and second, conducting a data protection impact assessment or risk assessment. The reforms are proposing that the records of processing activities and the DPIA need to be conducted only when controllers or processors are engaging in high-risk activities. Therefore, most organizations would be exempt from these obligations. Again, in some ways, this reflects the day-to-day reality of data protection regimes in firms, because most firms run their privacy programs and focus their risk assessment on that most high-risk activities in the first place. Next slide, please. The GDPR requires organizations to establish a lawful basis for processing personal data and declare this upfront in privacy notices. Of all the lawful bases, the most flexible is legitimate interest. For example, if a firm identifies a valid commercial interest for processing personal data, then it may do so unless the activity breaches the fundamental rights of individuals. This is called the balancing test. The original iteration of the bill proposed that businesses could rely on legitimate interest without the requirement to conduct a balancing test. However, subsequently, the stance has changed. Now, the bill sets out clear examples of when legitimate interests may apply, such as for direct marketing activities, but it still requires organizations to perform a balancing test. Next slide, please. The bill proposes a reform to the right of access obligations. Controllers can refuse vexatious or excessive data subject access requests. Current guidance from the Information Commissioner's Office on the right of access provides a limited list of circumstances where manifestly unfounded, manifestly excessive DSARs may be rejected. For example, if an individual makes a request, but then withdraws it in exchange for a benefit from the organization. The scope, in the current iteration of the bill, the scope of what falls within vexatious or excessive seems to be broader, and there's more clarifications provided on the matter. Controllers will now be able to take into account their resources and may be able to refuse requests intended to cause distress or not made in good faith, or which are an abusive process. The devil, however, is in the detail, and it is hoped that the ICAEW will issue guidance in due course to shed some light on where the line is drawn. Slide, please. This is an interesting change that the bill proposes, and that is to the role of the ICAEW itself. The Information Commissioner's Office is to be replaced by the Information Commission. The Commission will have additional duties, example, having regard to promoting innovation and competition. The Information Commission will be subjected to greater parliamentary analysis, and the Secretary of State has the ability to put forth a statement of strategic priorities which the Information Commission will have to consider. Throughout the data protection reform, it is this reform that has generated great debate, because there are concerns about whether or not the IC will be truly an independent regulator. In recent podcasts, however, the present Information Commissioner has tried to allay the fears and has provided assurances about the ongoing independence of the regulator. Slide, please. So what is the likely impact of this bill? The bill in its current form is in proposal stage. However, in the two readings of the bill, the changes proposed have been minute. So the likelihood is that given the insignificant changes between the first and second readings, it looks likely that the data protection and digital information bill will be enacted in this current form in the foreseeable future, perhaps next year, early around March. If enacted in its current form, the impact the bill will bring is arguably a ripple. Given the remarkably high standards of data protection required by the EU that need to be maintained wherever EU data is transferred, the UK government only has so much room to maneuver. For that reason, the proposed bill does not overhaul the data protection landscape that we have matured with over the last 5 years, when the GDPR became applicable. Whilst the proposed regime may make the existing data protection law somewhat less prescriptive, companies operating in a more multinational sphere and across Europe and beyond may well want to maintain the one GDPR standard and tailoring their UK compliance to perhaps the new, less rigorous regime. Thank you. That concludes my presentation. Thank you, Marie.
Thank you very much to you, Seema, and Victoria, and Susie. Why not join me on the screen? I do have some questions for you. So just before we get to those questions, I can see there's quite a lot of activity in the chat and in the Q&A, specifically around the slides, which have obviously hit the mark where our guests today are concerned. For those that joined late, we have put the slides in the chat on a few occasions. It's saved as a PDF file. You can go into the chat and download them from there. I appreciate that some people have dialed in on their phones or other sort of mobile devices and might not be able to access those, we will email those out to you next week. Right, so moving on. So in the interest of time, I have had quite a few questions through, but I'm aware, I know that Jeremy's waiting in the wings. So I'm going to hold back a few questions and I'll pass those on to you later on so that you can go back to delegates directly. But in the meantime, so I think Victoria, this is probably one for you. So how would you suggest that CPD is evidenced in training records? So for example, would a copy of a booking form or a booking email be sufficient?
Yeah, I think that's a really good idea. I think what the ICAEW have asked for is one piece of evidence per CPD training. But I think that's a good idea. There's also, if you click through some of the links that we've provided in the slides, there are also some really useful pro forma that the ICAEW have provided. And there is one that gives, it's a little form that basically records the training that you've completed and also the reason for it and sort of what you've got out of it. So I think that plus the records of your booking would be absolutely perfect.
Great stuff. And I think, Suze, this is probably one for you. So how important do you think the accuracy of the information available at companies' houses in the fight against money laundering and financial crime?
I actually think it's really important. I think what's been identified in the last few years, and certainly is coming through in the proposed legislation, is the extent to which the use of companies in the UK for criminal offences has been quite wide. And I think what's been identified is the sort of extent of the misinformation that has been filed at Companies House. Recently, I think over sort of 10,000 people it just in 1 year notified Companies House that their addresses were being used for without their consent in Companies House. So I think there was a lot of misinformation there, and I think particularly for the UK FIU when they are investigating criminal offences, the information that at Companies House does lead them to be able to make connections between parties, identify, for example, if there are addresses which are being used for a wide number of companies, but perhaps seemingly on a residential address, has happened recently. So I think that information at Companies House is a very useful tool for those who do need to investigate money laundering and financial crime. So I think it's a very useful tool. So I think the legislation is very welcome in the efforts to combat that.
Very good, thank you for that. And just one final question. I think, Seema, this is probably one for you, actually. So this is obviously relating to the bill that you were just talking about under your session, but does the bill say anything about the definition of personal data?
Yes, the bill does provide a little bit more clarity about when personal data is identifiable and when it is anonymous, and also it provides clarification on the status of an individual's personal data if it is breached, and if the breached data can be used by third parties and piece it together to identify more information about the individual, then that data at that point when it's breached does become personal data.
Perfect, thank you. Right, I think I'm going to wrap up those questions now and move on to the second part of our session. So thank you very much to our quality and risk team for joining us today, making their debut at the K3 Hub. So as I said, moving on to the second subject matter this morning, which is an update from our tax investigations team. So for those that regularly join us here at the K3 Hub, I'm sure that you'll recognise Jeremy. So I'm very pleased to recognise my colleague Jeremy Johnson back to the K3 Hub. Jeremy is the managing director at our sister company Intex. Jeremy specialises in tax investigations and helps clients to proactively manage and resolve HMRC enquiries, disclosures, or risk reviews, whether they're fraud, evasion, avoidance, or other enquiries. He is, for his sins, a former senior HMRC inspector, and therefore has got substantial insight into the approaches, procedures, and inner workings adopted by HMRC, and understands the boundaries within which it should operate. Jeremy, over to you.
Good morning, Marie. Good morning, everybody. Thank you for the introduction, Marie. It was advertised I was going to cover two things. I'm going to try and rattle through three things this morning. The first of which is R&D, what's happening in relation to R&D inquiries from HMRC. Second is payroll, labour providers, umbrella companies. I've touched on it before, but it's worth a reminder, I think. And then finally, the one area that wasn't advertised, but it's probably worth touching on, is the subject of property incorporation schemes. There's been a lot of press about those recently, so a few thoughts about those and what might be happening next. So if we have the first slide, or the next slide, sorry, in relation to R&D, just jumping back in time, where have all these R&D inquiries come from? I'm not sure. There we go. There should be a survey popped up. I think I know what the answers are likely to be. Whether you've recently had an inquiry for a client in relation to R&D, and whether you've had one in the past. So jumping back to the beginning, and just to say, it says people can't vote at the moment, so I don't know if that needs to change. So jumping back to 2020, 2021, HMRC started what they called a random mandatory inquiry program into 500 R&D claims. The results of that inquiry program were that HMRC found that in the SME regime, there was about 24% error and fraud, which is a pretty high number. In the RDEC area, they found about 3.6% error and fraud, so obviously considerably less error in the larger company regime. The research is on the internet if you want to go and look at it. HMRC's published it, and they've sliced and diced the data in different ways in terms of how the SIC code or the size of the business, or whether there is an advisor, has impacted the amount of error and fraud. One of the things that, and from that, they've been profiling companies to pick up for inquiry, and probably since about October last year, there's been a pretty significant campaign of R&D inquiries going on from HMRC. In terms of the distinctions, there have been two campaigns. There have been normal inquiries, which are looking at technical issues. Does this qualify? There have also been quite a lot of FIS inquiries, or fraud investigation service inquiries. The distinction between those is that the FIS inquiries have been looking at typically claims where there's a loss in the company and the claim is creating effectively a cash credit. And FIS are looking to make sure that there has actually been something done, never mind whether it qualifies, something has actually happened. The issue being potentially that people are putting claims in where really nothing has happened at all and it's entirely fraudulent. So FIS open inquiries, normal teams opened inquiries. Within the normal inquiries, there's a further distinction. So some people may have received inquiries from a named inspector. There's a person with a phone number and an email address, and you can have a dialogue. Other inquiries were opened by a pretty large caseworking team, and they're worked on a team basis. Typically, there's no name given in terms of who is asking questions, sending responses. Those, in my experience, those can be a little bit frustrating because they might move from caseworker to caseworker as each round of correspondence goes on, and you lose a little bit in the translation there. If you've got an inquiry from an inspector where there is a name, a phone number, potentially you're going to find the job of dealing with that a little bit easier. In terms of some of the issues that, and the issues are well documented, the CIOT has written an open letter to HMRC, effectively complaining about some aspects of the approach. And I think the complaints really derive from the industrialization of the process, and it's been a bit suboptimal. But some of the issues in the process have been delays from HMRC, some poor analysis of them in terms of what should and shouldn't qualify, poor reasoning on penalties, some elements of superficial research by HMRC where they're picking up, there's another product just like this, I've Googled it. Well, that doesn't mean that there wasn't R&D. And one of the other things is HMRC saying that the competent professional is not actually a competent professional. And in some cases, it's felt almost like HMRC is suggesting that the competent professional needs to have received a Nobel Prize in the field that they're working in order to be a competent professional. And bearing in mind that, one of the regimes is the SME regime, there probably aren't many Nobel Prize winners working in SMEs. So HMRC's approach has been beset a little bit by some administrative issues and some poor analysis in some cases. Where we've been involved, at the issues with the actual claims themselves, or the things that come out. Firstly, obviously, if there's no R&D, that's clearly a big problem. It's an area that hasn't been policed for some time. And there are some very, very good providers of R&D consultancy, and there are some providers who really aren't as good at all and don't seem to have a great deal of knowledge, and they're putting forward projects which simply aren't R&D as being qualified, as being qualifying. And if that's the case, it's simply going to fail at the first hurdle. But in more general terms, some of the issues we've seen with reports and some of the issues that we've seen with correspondence with HMRC, some R&D reports seem to, it seems to be that the author of the report feels like that they have to produce something that's 50 to 100 pages long to show that they've done work for the fee that they've received. Really, the report, it may need to have a lot of detail, but in the first instance, the report really needs to, or really should, clearly define what the project is, clearly define what the advance is, where was the baseline, where did we move to, why is the competent professional a competent professional, and some uncertainty. So kind of going back to the basic points of the BEIS guidelines, and in a summary form at least, and it can be expanded on later in any report or correspondence, clearly outline how those fundamental boxes of what is R&D have been ticked. If HMRC's got to wade through 50 or 60 pages of a report to try and pick out the things to allow them to tick the boxes, it's much easier for them to just say no. Whereas if you make it easy for them to say, we understand how these have been ticked, you're going to have an easier job. One of the things to pick up on the FIS inquiries is in a number of inquiries where FIS have become satisfied that there isn't a fraud, sometimes they've asked some technical questions. In some instances, they've decided fairly summarily that this isn't R&D. An inquiry hasn't been opened and they've simply corrected the return. So if FIS have corrected a return and you're in that position, you've got two options. One is if the return is in time to be amended, you can re-amend it to re-include the claim if you think it's appropriate. Or if you're out of time now to amend the return, you would need to reject that correction made by FIS. If you don't agree with what HMRC say, the usual options, or whatever their conclusions are, the usual options are available. You can appeal, review, tribunal ultimately, if it's worth going that far. For larger claims, it may well be that ADR is a useful forum for dealing with this, because sometimes there's a lot of fact and detail. So being in a forum where the parties can sit down and go through that, ADR might be a good way to resolve that issue. So in terms of the survey, it's not as marked a difference as I thought. So in the last 12 months, 36% of people have had an inquiry. Prior to that, 26%. So I was expecting a bigger difference, but in both areas, a fairly substantial number with no inquiries. So I think individual experience is reflecting an uptick, but for lots of advisors, it's not a massive uptick. So there we go. So that's R&D. If you could move on to the next slide, just touching again. I'll just wait for that slide to pop up. Touching again on payroll, HMRC is looking at this still, labour supplies, umbrella schemes. HMRC estimates that of the marketed avoidance loan schemes, umbrellas involving loan schemes, about 90% of marketed avoidance is that kind of avoidance. It simply doesn't work. I'm astonished it's still being sold, but it's still out there. The other thing is where you've got labour, where you've got chains of supply involving payroll suppliers, there has been fraud, and HMRC believes that there still is fraud in those labour supplies. So the important thing for clients is, if they're buying in labour and then potentially reselling it, if they're part of a chain of labour supply, really important to do due diligence on the supplier that's providing the labour to them, and making sure that what they're paying is commercial. If you have a client who's paying a labour supplier an amount where, when you look at it, you can't understand how the labour supplier could possibly be making a profit, that's a fair indication that their profit may be some tax that they're simply not going to pay, and that can cause a problem for the person buying it in, certainly from a VAT perspective, where you've potentially got kittle challenges on the VAT if there's been a defaulting supplier along the chain. So I've touched on this subject before, so I'll leave it at that. But it's always worth looking at where there is a labour supply chain, making sure that clients do due diligence. The final thing to touch upon, if we can skip over to the next slide, property incorporation schemes have been in the press quite a lot recently, kind of in the tax press and also in the national press last weekend. In the press, two arrangements have been highlighted, one of them involving the movement of properties into a limited company by virtue of a trust. Another one involving an LLP with a corporate member. That second one with the corporate member has been effectively the subject of a spotlight by HMRC. HMRC is saying it doesn't work. Spotlight 63, which you can find on their website. In terms of the history of property incorporation, property incorporation on its own is fine. Section 24 in 2017 reduced the amount of interest relief individual landlords could get on property portfolios, on residential property portfolios. A number of landlords decided to incorporate. Incorporation on its own, that's okay. It usually goes through several steps over a fairly lengthy period. A couple of arrangements, HMRC, I think, well, certainly one of them, HMRC, believe that there's an issue with. The one that's in the spotlight, one of the issues that HMRC has highlighted is the mixed membership legislation, section 850C. The way that this particular arrangement works is that the property portfolio is moved into an LLP. The LLP then has a corporate member, and it's presented that the profits can be allocated to the corporate member. Now, the advantage of that potentially is that the corporate is going to pay tax at 20%. The corporate member can sit on the money for a period of time if it's not needed by the landlords, and it's potentially better than the landlords or the individuals paying tax at 40% or possibly even higher, depending on the size of the portfolio and the income. The issue with that is the mixed membership legislation looks to stop an artificial diversion of profit from an LLP to a corporate member, where you've got an individual member of the LLP also controlling that corporate member. The legislation looks at whether there is excess profit. So if I had an LLP, if me and my wife had an LLP, our properties were in the LLP, we have a corporate member. If we diverted 80% of the profit to that corporate member, but the corporate member does no work for that profit, the legislation would seek to reallocate the profit back to either both of us or one of us, depending on who owns that corporate. So from a mixed membership point of view, the corporate member structure, depending on what the corporate member does, could have some problems, and HMRC would seek to reallocate profits from the corporate member back to the individual. Depending on the individual's marginal tax rate, that might result in an increase in tax. A number of other issues have been highlighted in relation to these arrangements, in terms of whether loan interest relief would be available at all because of the way the structure is implemented, SDLT, CGT, IHT. When we've had a look at these areas, there are certainly risks. I wouldn't say that every one of these risks is an absolute slam dunk, that it's wrong in every single case. It's going to depend on the circumstances of what happened before the structure, how's the structure been implemented. But the cases that we've looked at and the inquiries we've had about this there are certainly some areas of risk, and in some cases areas of significant risk. In relation to the mixed membership arrangements, HMRC has issued a spotlight. They've said that they don't believe it works. We would expect in that case, HMRC is probably going to be opening inquiries into all of those LLPs and possibly the limited company, well, probably the limited companies that are associated, probably the individuals as well. So they'll be taking a pretty hard look at that. For those people who've gone into the arrangements and they're concerned and they're thinking, well, should I exit? The first thing to do, obviously, is to look at what's happened, identify if there are significant risks there, whether something has clearly gone wrong and the tax returns are submitted are wrong. Exit is possible on the mixed membership legislation, on the mixed membership partnership cases. HMRC is suggesting that you can contact them. I would suggest understanding what the landscape is for exiting would be really important when people are deciding what to do and how to do it. And how people exit, if they decide that they want to exit, may be different depending on the circumstances of individuals. So property incorporation, you know, it can happen. There are some arrangements which may have caused issues. And if that's the case, it's worth having a look at. I'm going to wrap up now because we're 2 minutes to 10. So I'll pick up any questions and then people can continue their days.
Thank you very much, Jeremy. That another super interesting update there. So in the interest of time, I've got a couple of questions for you. I think I'm going to hold back one, but there's an interesting question here relating back to the R&D subject matter that you covered. So I'll just read the question as it's come in. So have you seen much from HMRC in terms of more sensible R&D challenges in terms of the definition of science and technology? The person that's asked this has said that they're thinking about things like data science and machine learning, etc.
Have I seen more sensible challenges? There's a lot of challenges around. There've been a lot of challenges around software, and historically, HMRC has challenged software, particularly very large organisations who've got large IT infrastructures. The issue being, if you're spending £10 million updating your IT infrastructure, are you really pushing science and technology on, or is that just making your internal administration a bit better? And there's no uncertainty. None of it's massively, it may take a lot of time and people, but it's not pushing forward science and technology. So HMRC has been challenging, if that's kind of the question in relation to software, they've been challenging that. Have I seen anything specific around AI and data science? I haven't. But software has been for a while certainly a point of contention. Is it really moving technology forwards, or are we just using existing things in a slightly different way and there's no change in science and technology?
That's great, thank you. Okay, so I'm conscious of the time now, so just a quick wrap up from me then. So I just wanted to draw to your attention a couple of other forthcoming K3 Hub events. So we have a CPD event on the 3rd of November. We'll be welcoming back Malcolm Greenbaum, who will be delivering a corporate tax update for us. Malcolm is always extremely popular with us. And another really popular one of our events. So we'll be back on the 24th of November with another Accentuate event like today. We'll be running an autumn statement briefing by a very regular speaker of ours, Jeremy Mindell. And I know that we've got registrations for those already. So if you haven't seen your invites, do watch your inbox next week. They will be winging their way to you. Other than that, it's 10 a.m. Thank you so much to you all for taking the time out of your Friday mornings and spending it with us here at the K3 Hub. Have a great weekend and a great rest of the day. Thank you very much.